This is The Last Word with me, Menace Crenny. Moving closer to QE3. The dollar weakens ahead of last month's Federal Reserve minutes. Investors are waiting for any signs of a looser policy stance in the US. For more now, see how it's actually been played out in the markets. Let's head to the CME Group in Chicago, where we can speak to the Chief Investment Officer at SFG Alternatives, Larry Shover, joins me now. So, Larry, I mean, it's a big build-up. Just how convinced are you guys down there that QE3 is part of the agenda tonight?
Yeah, you know, expectations are clearly rising, but the outlook is definitely not clear, and I don't think the market's expecting anything today. I think we're looking for August 1st for something. I mean, clearly they're moving in a direction of doing something. We just don't know what. I think what we're expecting today is a lot of recycled verbiage that Bernanke is so good at, talking in more ambivalent tones about near-term growth and about how the government needs to do more. But right now, expectations are rising, but no one seems to know exactly what's going to happen right now.
Now, you say actually what's more critical for the market is probably July 17, 18, when we get Bernanke's testimony. And do you think he might go for a change in tone there? Is that what you're hoping for?
Yeah, we're hoping for a change in tone, or at least maybe let us in on what you're thinking, because there have been rumors that maybe they'll extend Operation Twist, but change it a bit where they're not going to sell as much short-term treasuries and buy a lot longer term. So in effect, that would be a QE 2.5 if it were. But I think that's what the market's looking for, just a little bit more of a roadmap of what's going to happen here.
Do you know, I'm curious to get your view. Goldman Sachs, a couple of other houses said zero rates until 2013, the end of 2013. It's outdated, it's outmoded, and they're going to commit to 2014/2015. Is there chatter about that on the floor when you guys look at the pit?
Yeah, absolutely, because what we're looking at is, look what happened last week. I mean, Bank of England, Denmark, China, and ECB all eased policy last week. The market did not care. Furthermore, the way the Americans look at it is that we already have a QE3 in place right now, with 10-year yields being at 1.5. So what's additional easing going to do to the market? Is the market really going to care?
Well, that's what I want to pick you up on. 1.5 on the 10-year notes is the yield right now. The June lows were what, 145? Let's split hers on the absolute low.
That's correct.
Can we get back there? Or is that my near-term objective as I trade the 10-year part of the curve?
Absolutely, that is the objective, and you can see that in the options market. It seems like the overall market is skewed in the short term, especially in that end of the curve.
And obviously, we've got quite a bit of supply. With some 3-year bonds come to the market yesterday. We're waiting on a big lump of 10s to come into the pit tonight. Is that, what, $21 billion? Are we hesitant ahead of that, or will they just gobble it up?
I think they're going to continue to gobble it up, because right now it seems like there's an endless amount of demand for the U.S. Treasury. I mean, that's something the market, including myself, got exactly wrong. We just thought that this would not continue to happen and persist. But because of the lack of roadmap or credibility in Europe right now, it seems like as long as that continues to go, as long as that persists, we're going to see demand in the U.S. Treasury.
Larry Shover, Chief Investment Officer at SFG Alternatives. Thanks for the insight from Chicago.